Enbridge, North America's largest pipeline operator, has gone 53 years without a dividend cut and has consistently increased its dividend for 22 consecutive years. The dividend is increased, but how solid is this giant really? And is the dividend still safe despite high levels of debt? Enbridge operates the largest pipeline network in North America. Around 3 million barrels of oil flow through the pipeline every day. Enbridge has 4 business segments: oil pipelines, gas transportation, gas supply for households, and renewable energy. Enbridge is not just oil and gas. With customers like Meta, Amazon, and AT&T, the company is also involved in the boom of AI and data centers. Now let's take another look at my entry point. This was at €40.35. In total, I hold 2 shares, which corresponds to a price gain of 3.7% and a dividend of €2.58, which I have already received. Currently, the position is still small because the entry price was already a bit higher. Back then, and even now, that's still the case. As soon as Enbridge drops again, I will definitely buy more. Here we can also see once again the solid 5-year dividend growth, which stands at 4.51%. Overall, dividends are paid out quarterly. Over 10 years, we've even seen a dividend increase of 9.94%. Now, let's analyze the fundamentals again using InvestingPro. You can find the affiliate link below in the video description. With my link, you'll get a 15% discount. The 52-week high, or rather, low, is between €34 and €42, currently at €41.69. Analysts have set a target here of €39.12. We have revenue of 64.5 billion Canadian dollars. That's an increase of 20% compared to the previous year. We have EBITDA of 16.9 billion. That's an increase of 7%. Compared to the previous year, we have a net profit of 6.6 billion Canadian dollars. We have a debt to EBITDA ratio of 4.7. We are carrying a heavy burden mainly due to acquisitions of US gas suppliers. We have a dividend yield of 5.6%, paid quarterly. Here we also see the growth rate, so 22 is stable, and we have a payout ratio of 128.21%. On an earnings basis, a payout ratio of over 120% seems risky. On a cash flow basis, which is more important for pipelines, the rate is between 65 and 70%. That means these are solidly covered. The management's goal is to increase the dividend by 7% annually. For income investors, Enbridge is a real rock. The company is in a good financial position. We have an investment program of 32 billion Canadian dollars in ongoing projects. We have the Clear Fork Solar project in Texas with $900 million and a power contract with Meta. Enbridge is connected to 100% of the US LNG export capacity. We are close to new data centers and power plants. Demand driven by AI and the energy boom. The forecast is between 7 and 9%. EBITDA growth through 2026. The risks and the weaknesses. A debt burden of 4.7 debt to EBITDA. Difficult to push when interest rates are high. Canada. Political hurdles. Emission limits and tanker railways, the expectation. We have a high cost to earn compared to growth. That could become a possible stumbling block. So I'll just leave it here again for a moment. I'll leave it up briefly so you can take another look at it in peace and feel free to pause the video if you like. Here it is listed again as a SWOT analysis. The strengths, the weaknesses, the opportunities, and the threats. Exactly, once again, the bullish highlights and the bearish highlights. Right, you can definitely take a look at it here as well. Based on the latest official positive report, which was already very well analyzed and researched by InvestingPro, you can just pause for a moment and read through it in more detail. Here are the key data points for you. So I would say let's take a look at the whole thing from a fundamental perspective. This time, we're already analyzing directly on a euro basis. We are now at the start of the month, which means each candlestick basically represents 1 month. As we already saw earlier from the key data, we are already further along, moving higher, up in this area. That means for now, I wouldn't want to buy here and would rather wait to see what the market does. Offers, and my potential buyback zones would be here, for example, at minus 30%. That means it would be 27.18 euros and once at the 61.8 Fibonacci level. That would be about minus 47% from the current price. That would then be at 21.80 euros or 21.70 euros, as we can see. Here, wave 5 completed from 5. For now, I expect the price to come down in the short term. At least that's my expectation. And then, of course, I want to buy in further down. And that's exactly the reason why I haven't bought more so far, and unfortunately only hold such a small position. That's it for Amplage. It was a brief overview. Now just a quick conclusion. Amplage is not a growth miracle, but a stable dividend payer with a huge network. The dividend appears high based on earnings, but it is covered by cash flows. For investors who value reliability and income, Amplage remains interesting. If you're looking for a skyrocketing stock, I think you'll have to look elsewhere. That was part 3 of the pipeline series. The next video will follow shortly. And as always, this video is not investment advice, but simply my personal strategy. Do your own research. And I'm looking forward to the next video. Feel free to like the video and leave a comment. I'd always be happy about a subscription. Until then, successful investing.